Hey everyone, and welcome to Unit 4. Today we're looking at how we handle bad and doubtful debts, how we set up allowances for those doubtful debts, and how when we find out that a debt is actually bad, we write it off. Okay? So, I think the best way of doing this is to just jump straight in and we'll begin looking at our definitions of bad and doubtful debts and the risk that comes in credit. So let's jump in. So when we're looking at bad and doubtful debts, we need to start with the fact that when we're looking at credit transactions, we're considering the fact that we are counting revenues and assets that aren't guarantees. So these credit sales we take on, sometimes people will disappear interstate, overseas, just to avoid paying their debts. And some people, despite their best intentions, will be unable to pay. They will go bankrupt and they will either only pay a portion or they will pay nothing at all. So, as a business, we are considering our credit sales as revenues and we are reporting our accounts receivable as assets. And that implies that there is a complete certainty in what we're doing. But there is technically no certainty when it comes to the fact that that debt will be collected. This leads us to two major questions. Should we recognize all of our credit sales without doubt? Should we make a sale and then just not report it going, probably not going to get that money. We'll just report a loss of inventory? No, of course not. But should we ignore the possibility that not all of our debts may be collected? Do we report everything as, yes, this is 100% certain? Again, no. A faithful representation of the business says that our credit transactions are revenues. The likelihood of them coming in is very high. But we can't ignore the fact that some of it may not come in. This leads us to our allowance for doubtful debts. Now, a bad and a doubtful debt are very similar. The allowance for doubtful debts is what we call a negative asset. As such, it's on the balance sheet, okay, under the assets section. But it's a negative, okay? Now, this recognizes that some of the amounts owing by accounts receivable, they're not going to be collected. So as a result, they actually reduce that accounts receivable asset, okay? A bad debt is when we actually write off a specific account of a credit customer because we recognize that that individual customer won't be paying the amount of money that they owe to us. It's at that point that we call that a bad debt. So it's really important that you use the right terminology in exam questions and in your SACs. That will be something that will be marked down if you use the wrong term. So when we're establishing our allowance for doubtful debts, we consider how many debts are going to be doubtful based on a percentage of total credit sales. Now, for some businesses, 5% might be an adequate amount. For other businesses, 10% or even 1%. It just depends on your track record as a business. So, in the example that we're going to use here, we're going to use 5%, okay? And it's 5% of credit sales that were $100,000 over the year, so our allowance is going to be $5,000. Now, in setting it up, what we need to first do is we need to record our expense. So here we have our bad debts expense on the debit side, and our allowance for doubtful debts, which is a credit side transaction because it's a negative asset. Okay, so it uses rules opposite to that of assets. Okay, as I've mentioned before, our allowance for doubtful debts is recorded on the balance sheet. It's a negative asset, so therefore being an asset, it must be recorded on the balance sheet, and it looks like this. Okay, so it actually shows a negative under your current assets, reducing the balance of accounts receivable from 100,000 down to 95. Now, you'll see that we still report the $100,000 in accounts receivable because that is a verifiable amount and we have the documentation to show that. But that allowance for doubtful debts figure of $5,000 still reduces it because that's going to give us our faithful representation of the business. So once we've established our allowance, and that is sitting on the balance sheet, we now have it standing by for if we ever have to write off a debt. So let's look at an example of how we actually go about writing off a debt. And in this example, we're going to look at someone who has to pay off, or had a debt to pay off, of $4,400, which included $4,000 of GST. Okay, so here our credit customer is Con Job, and he is declared bankruptcy. So it's really of no fault of his own. It's just that he is unable to remain trading. So this is the general journal that we put in. So we have our allowance for doubtful debts being reduced because we're using up that negative asset as we write off the account receivable. We reduce our liability of GST clearing because we no longer have to pay it. Okay. And also we write off that entire account receivable. So if you look at the ledger account of the allowance for doubtful debts, you'll see that this negative asset, because we wrote off C Job's account, it's been reduced by $4,000. Okay, so this will be used up every time we have to write off a bad debt. Now this brings us to the consideration: if at the end of the year we've got $1,000 left in that allowance for doubtful debts, are we actually putting aside too much money? Is this a faithful representation, or have we been too conservative? So the business may choose to adjust this in future years, and that's what we're going to look at now. So let's say that instead we're going to build the allowance back up with a new estimate of 4%. Okay, so here we have net credit sales of 110,000, and we're putting aside 4%. So funnily enough, we are going to put the balance from the 1,000 that it was here. Okay, so we initially had 5,000. The balance has gone down to 1,000 because we've used it up. And we've decided we need to bring it back up to 4,400. Okay, because that's 4% of our credit sales for the next period. Okay, so let's look at that example. And you can see we want the balance here to be 4,400. So what we've done is we've built it up to 8,400, and that's been carried down. Now, to make the adjustment of that balance, we put it aside the exact same way as when we established it, through the bad debts expense. So you can see here the amount that brings us from our old balance up to our new one is 3,400. Okay, so you remember we already had $1,000 sitting there, so we don't need to increase that expense by 4,400. We've already done that in the previous period with the 5,000. So we only needed to add 3,400 to bring it up to this balance. Okay. When you see a difference here, it usually means that the estimation was too high in the previous period, as you can see. Hence, it's been reduced. Now, this can happen in reverse sometimes, where our estimation is not large enough, and I'll show you an example of that in class. But it's important to remember that the bad debts expense is automatically adjusted each period, regardless of whether our estimation was too high or low. We just put aside however much money is needed at the start of each period to establish that allowance, regardless of the value that we've set. Okay? And we record that in our general journal as follows. Okay? So whenever you're topping up the account or you're establishing it, this is always going to be the entry you use. Every single time. There is one last complication, and it's that sometimes when people go bankrupt, they might pay a portion of the amount that's owed. It might be 20% or 20 cents of every dollar, as they say. It might be 50 cents of every dollar. It just depends. In this case, let's say that instead of $4,400 being written off entirely, he was going to pay 25 cents in the dollar, or 25%. Okay? So that means that we're receiving $1,100. We do it in the following way because we still need to write off $3,300, and we say we've received $1,100 in cash, and our allowance for doubtful debts is being written down by $3,000. We are still writing off that $300 of GST, and we're still completely clearing the amount that he owed us because we're considering his debt finalized and paid. When we're doing the check your understanding questions, I'd like you to complete all of them and all of the chapter exercises. They're all very good for setting up the allowance for doubtful debts and writing off bad debts. Okay, so it's really important that you go through all of those. Setting up an allowance for doubtful debts and writing off a bad debt is a very structured process and always follows the same methods. So the general journals will always look the same. The ledger accounts will always look the same. And the process that you go through will always be the same. This is an area that's based very heavily in the idea of faithful representation versus reliability of figures and things like that, because we are trying to balance an estimation of how many of our debts are not going to pay versus the reliability of the figures that we have from our credit sales. But with some practice, I'm sure that you'll do fine. If you have any questions, let me know. And otherwise, good luck, and I'll catch you next time. Bye.